Welcome to The Explainer. Today, we are unpacking the huge events of September 16th. It was just a single day, but a high-stakes decision made in Washington, D.C. sent these massive shockwaves through the entire global economy.
So here's how we're going to break it down. First, we'll look at the buzz on Wall Street. Then we're going to dive right into the Federal Reserve's big dilemma. After that, we'll see how the pros were playing it in the bond market, then zoom out to a really surprising trend popping up in China. And finally, we'll wrap it all up and figure out what it all means.
Okay, let's get right into it by checking out the headlines that had everyone on Wall Street talking.
On September 16th, U.S. stock markets were just on fire. Both the S&P 500 and the NASDAQ closed at record highs. You could just feel this powerful wave of optimism coming from investors. Things were looking really good.
But that's the million-dollar question, isn't it? What was the one big thing fueling all this record-breaking confidence? Why was everybody suddenly so bullish on the market?
Well, the answer wasn't on Wall Street. It was in Washington, D.C., where the U.S. Federal Reserve was about to make a huge decision. And you better believe the entire market was holding its breath. See, the big bet, the widespread expectation, was that the Fed was going to cut its benchmark interest rate by 1/4 percentage point. A move like that makes it cheaper for everyone to borrow money, which usually gives the economy a nice little boost. Now, to really get why they do this, you have to understand the tightrope the Fed is always walking. They've basically got two main jobs, and sometimes those jobs are in direct conflict. Their mission is to keep inflation under control while also making sure as many people as possible have jobs. And this slide just lays out their dilemma perfectly. On the one hand, the U.S. job market was showing signs of weakness. Unemployment ticked up to 4.3%. That's a huge reason to cut rates, right? To help boost hiring? But on the other hand, inflation came in hotter than expected, and that normally tells the Fed to hold steady or maybe even raise rates. Talk about being stuck between a rock and a hard place.
And as if that wasn't dramatic enough, the Fed was also dealing with some serious political heat. There was this unprecedented attempt from the White House to remove a sitting governor, a move that the courts had to step in and block. It just goes to show you the intense fight for the central bank to stay independent and make calls based on data, not politics.
Okay, so with all that as the backdrop, how were the professional investors, the smart money, placing their bets? They weren't just sitting around waiting. They were already making moves.
So to understand their strategy, you really only need to know one key term: duration. It sounds complicated, but it's pretty simple. Think of it like a lever. The longer a bond's duration, the more its price swings when interest rates change. So if you think rates are about to drop, what do you want? You want bonds with a long duration.
And hey, don't just take my word for it. As this top strategist at Morgan Stanley puts it, it's basically math. If you bet on longer duration and the Fed does cut rates, you should make money. It's a straight-up bet that interest rates are headed down.
And this wasn't just some theory. The data totally backs it up. A J.P. Morgan survey from right before the decision showed a clear trend. Their clients were piling into these long-duration bets, jumping from 28% to 30% in just 1 week.
But they were also making even more complex plays. One really popular trade was called the steepener. In simple terms, this is a bet that the gap between short-term and long-term interest rates is going to get wider or steeper. To do this, traders buy up short-term bonds and sell off long-term ones. They're positioning themselves to profit if short-term rates fall faster than long-term ones, a scenario some folks thought was likely, especially with all the concern over the huge U.S. deficit.
So while everyone in the U.S. was laser-focused on the Fed, that very decision was creating ripples halfway around the world. A really surprising story was starting to unfold, and it pointed to where global money might be looking next: China.
It wasn't that long ago that global investors were running from China's markets. People were literally calling them uninvestable. But now, that whole sentiment is flipping, and foreign money is starting to get curious again.
And you can see this shift so clearly in the numbers. Look at the dramatic drop this year in new investment funds that are specifically designed to exclude China. That's pretty strong evidence that investors don't want to avoid China anymore. They want back in.
But, and this is a big but, while the interest is definitely there, the big money is still playing it cool. As this quote suggests, they're kind of just standing at the door, watching, waiting to see if China's economic recovery is the real deal before they jump back in with both feet.
So as we pull all these different threads together from this one really crucial day, the market is left with one pretty clear answer and a whole bunch of brand new, very big questions.
And here's the big takeaway. On one side, you have today's certainty. The market is convinced that Fed rate cut is a done deal. But on the other side, you've got this giant, looming uncertainty for tomorrow. A huge Supreme Court ruling on tariffs that could totally throw corporate America and the whole economy for a loop.
Which leaves us with this final thought. Is all this good news in the market today just the calm before a much bigger economic storm? One that could be triggered by something else entirely? It's a question that just shows you how fast this whole landscape can change.